wanted to talk a little bit today about market timing versus taking advantage of market conditions. So when I talk about not market timing, that's when I'm talking about somebody emotionally seeing what's going on and deciding that they want to pull all their money out of the market and sit on the sidelines. And then they don't know when to get back in, or, hey, we're having an election coming up. I want to pull all my money. I want to go to cash. That's market timing. And of course, the DALBAR Research Institute out of Boston showing statistics have shown that when people do that, they hurt themselves. The main reason why is you have to be right twice. Even if you got out of the market to not have, we'll say a 10% downturn in the market. So you're sitting on the sidelines, but when markets move, they move very fast. And now you have the real question of when to get back in. And unfortunately, and obviously, I think most people don't get back in right at the bottom. Okay, they wait until that market turns. It turns really fast. And almost in an ideal world, let's say you got back in relatively quickly. So now you've only erased maybe 5% of that downturn. But in all reality, that's not the way it works. Somebody will get in, they'll erase some of the downturn, but they're normally getting back after the market's already surpassed where they got out. Had you just ridden the market conditions all the way through and stayed disciplined, then you would be ahead of the game. And that's what happens in most cases. That's why emotionally trying to time the market doesn't work. And the people that do that really, really hurt themselves. Now, let's talk about what's happened on the last couple Mondays. There's market conditions where there's an overreaction in the market. Now, this has to go into do with active trading. Not necessarily, maybe you have some money sitting on the sidelines and you can take advantage of the opportunity by buying in while the market's overreacting, or, straight asset allocation and trading. We can go ahead and sell some things that are down and take advantage of the reduced cost of some very good stocks that are having an overreaction and buy in low. So when we have a market that's overreacting, and normally it's a short-term thing, 1 or 2 days, or maybe even a week where something's going on and the market doesn't like those unknowns, we can take advantage of that market condition to make some trades and get a nice little pop of return for what we have going on. Over the long term, though, rather than having money just sit on the sidelines and build, because when we have a correction in the market, I have a lot of clients. They call me, they reach out. Hey, I got 25 grand. Let's get in right now. Well, once again, that is trying to time the market in a sense, because you're hoarding cash on the outside. A much better pay yourself theory that's going to get you ahead is just dollar cost averaging into the market. Because what that does is it forces you to buy more when things are low and less when things are high. So I would much rather than you hoarding cash, get that money into the market on a monthly basis. You know how we set up that monthly auto investment into, say, your personal account? If you start building cash, bump that up. The dollar cost averaging is going to lower your cost basis over time. It's a much more disciplined approach to investing where you're taking advantage of the time factor, okay? And we're still going to take advantage of market conditions with how we trade and actively trade a portfolio. But having your money sitting on the sidelines is not the answer. Trying to time the market in a macro strategy, or even in the short term, hey, I want to sit this out for a little while. It's a loser's game. It's like going to Vegas, and that's why we call it speculating and gambling with your money. When we look at all the statistics, the things that people do to hurt themselves, stock picking, unemotional market timing, and track record investing, and just not being a long-term, unemotional, disciplined investor. Don't let these happen to you. Play the long-term game, pay yourself first, be disciplined, and stay absolutely long-term and unemotional. If you do all these things, you're going to be fine for retirement. You're going to be way ahead of the emotional investor. And that's my job, to keep you unemotional.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.